And there's a very interesting quote that I heard. I can't remember exactly who said this, but tell me the state of venture capital in your country, and I'll tell you the state of your economy in 20, 30 years. And I found this quite profound because if you're investing in early stage companies, you basically invest in the future. And so that will drive your economy going forward, because investing in technology obviously drives productivity. Productivity drives GDP. So it's just an interesting quote that I thought I'll share before we get into it. What I have over here is a chart on the left of the total assets that are held by the Federal Reserve. And this is basically the money that has been printed by the Fed. And if you see where my mouse cursor is, in 2008, global financial crisis, to bail out the banks and the economy, the Fed printed quite a bit of money. It was around $2 trillion. And over the course of the next 10 years, up until 2018, to keep the economy buoyant, they went through what they called quantitative easing, where they kept interest rates close to zero, and they continued printing money or selling financial assets. So selling financial assets or printing money is the same thing, pushing liquidity into the system. And we see this went up from around 2 trillion all the way up to just under 5 trillion until 2018. I'm sure you've all heard of the taper tantrum, when the Fed stopped quantitative easing and started quantitative tightening. And quantitative tightening is when they allow these financial assets to mature. So this reduces the liquidity in the system, and that had implications in the market. And that was supposed to continue. They were supposed to get this down, but they had to bail out not only Wall Street, but Main Street and even households, and a lot more in 2021. This government stimulus was so massive that it exceeded all prior quantitative easing historically. So as up until 2021, we see when there was this massive stimulus, we see 2021 was a massive bull run for all asset classes. And this led to many interesting things. Here we have the valuation of WeWork. We see the valuation trend just skyrocketing to their last valuation was $47 billion for a company that was heavily loss-making. And actually, WeWork had a terrible business model. If you looked closer into them, there was lots of cracks. I won't go into that now, but it had to do with the asset liability mismatch, entering into these long-term leases with landlords, but then renting out on a short-term basis. That was a mismatch. There's a really TV series on Apple TV called We Crashed, about the founder, Adam Newman, and his whole story of WeWork. It's very interesting. I highly recommend it. Then we had the story of Theranos. They didn't even have a working product. VCs and investors invested hundreds of millions of dollars into Theranos, but they never did any due diligence, and this company collapsed. There's a nice book called Bad Blood. I highly recommend this as well. It's a very interesting story about the company and the founder. This happened not only in America, but all over the world. So China, same thing. Bike sharing companies from China raised hundreds of millions of dollars, valued at billions of dollars, and then all failed. You can actually see from satellite imagery, all the e-bike wastes or all the trash that the bikes that they have disposed of. So have been a lot of exuberance, a lot of liquidity in the system, has been a really good time for all asset classes. But then what happens since then? Inflation happened. The Fed started hiking interest rates to combat inflation. Inflation is like a disease for the economy. And as a result, we also have quantitative tightening happening now. So you see the liquidity is being drained out of the system. As a result, we see venture capital is also coming down. Stock prices have come down. We're in a new regime of high interest rates. Will interest rates come back to zero? Will the government print money again? It's very difficult to predict the macro, but just looking at inflation and where it's heading, and the bond investors' expectation is that interest rates will remain higher for longer. And so the environment over the next 10 years is going to be very different from the last 10 years. And that has implications for most asset classes, because as an investor, I would rather park my money in a US government bond or a fixed deposit, which is risk-free and earn 4 or 5%, or even put my money in a safer corporate bond and earn up to 10%, instead of putting my money into risky assets like small cap stocks or venture capital investments. The new environment or the new regime has implications for the industry. But you may say that, yes, there is an AI boom. We see NVIDIA, we see the Magnificent Seven like Meta, Amazon, Google. Their share prices are booming because of the AI boom. Here's an interesting article that I read recently was this country called Anguilla. I'm not sure if I'm pronouncing that correctly, but their country, like how you have Singapore would be .sg or South Africa is Anguilla have the domain .ai. And the government has been selling these domains, and apparently 1/3 have come from the sale of AI domains, just highlighting again that there is a bit of a bull run in the AI space. And when there's this bull run, we see these crazy things happening. So this bull run is limited to the AI space because we look at the top 4 companies here are all AI companies, and you see that the change in their valuation have been either a little bit down or somewhat upward movement in their valuation have been revised upward. But a lot of the other companies on the list here, their valuations have all been revised downward, and some up to almost 80% being revised downward. Okay, so as I mentioned earlier, we have this new regime, which is higher for longer. Interest rates are going to be higher for longer, and this has implications for all asset classes. Other than a few high-profile exceptions, investors are wary of lofty valuations, which is why we're seeing valuations being revised downward. There were 344 unicorns minted in 2021, only 45 were minted in 2023. At the end of the era of cheap money is largely to blame for this. So it's game over for a lot of startups. This article talks about tech startups running out of time and money because they burn. A lot of startups historically have just been burning a lot of cash. They've been heavily loss-making, expecting that every year they can go to the capital markets and they can raise funding. Unfortunately, that's no longer the case. And so you see 3,200 VC-backed companies went under in 2023. That's a lot of failed companies. Venture-backed companies are failing at record rates. So there's a huge problem in the industry, but there is a way out. And that way out is through a forced exit, where startup founders are trying to find buyers for their companies. They're trying to approach the larger tech companies like the Googles, the Amazons, other cash-rich companies to buy them out because they just need the funding to keep their operations continuing. And there is an expectation that M&A activity is likely to skyrocket in 2024 because of so many companies, not only VC companies, but also companies that have huge debt walls coming up, and they don't have the cash to pay down this debt. And it's difficult for them to refinance this debt at higher interest rates because they don't have the cash to pay the higher interest rates. So there's going to be a lot of M&A activity, especially with these failing companies. Then there's still a lot of money which is stuck in these private unicorns. Like an example is Canva, where they are yet to go IPO, and many investors want to exit and realize their gains. Many investors are sitting on huge unrealized gains in all of these unicorns. And a lot of these unicorns are now putting a break on going IPO because there were a few IPOs last year. 2 come to mind, Klaviyo and Instacart, and both of those were not very successful IPOs. So a lot of founders are waiting for better times to come before they can go IPO. Investors are a bit more cautious now. Investors don't want to invest in loss-making companies. So the IPO is not as successful as it was before. We know about the big tech layoffs that happened. We know about the Meta layoffs in 2022, the Twitter layoffs after Elon Musk acquired Twitter. In 2023, Amazon had massive layoffs, Google, Microsoft, Salesforce, so a lot of layoffs. But every cloud has a silver lining. So with all the layoffs, there is a lot of talent available in the market, and this talent is now more affordable because these laid off people are willing to take jobs and work for less. Growth at all costs is no longer the name of the game. Founders are starting to become more frugal. They need to be more cautious on their spending. They cannot just burn cash like before, and they have to focus on profitability. Startups spend most of their cash on engineering and marketing, and AI will significantly bring these costs down. For those of you who are using ChatGPT, I'm sure you are seeing the benefits. If you're a programmer or engineer, there's this thing called the 1000x engineer, where you can 1000x your productivity as a developer with ChatGPT. It basically does all your code for you. So it's very interesting. And personally, I'm learning Python programming because I think that it's essential and to be working in the coming years, especially dealing with AI. So let's talk about an introduction to startup valuation. So the nuance with startups is that you have to consider their stage of development. You have different stages, and we'll talk through each one. At the idea stage, when you're a founder, and you just have an idea, very difficult to go to VCs and raise money. You can go to family, friends, fools, angels to raise money. And don't build a financial model with a DCF valuation at this stage. It's just not practical, given that you just have an idea, and what will happen, expectation, reality will be very different from expectation. So typically, when you're selling some shares in your pre-revenue startup, we're looking at, like up to $1 million valuation. That too can even be too high, and you're giving away a small portion of your equity for that. And then you move on to the seed stage. At this stage, you want to have some revenue traction. You want to have product market fit. There needs to be a good enough market size for your startup. And at this stage, this slide is from a few years ago in Singapore. This may be different in your geography. In the US, it could be up to $10 million for a stage seed round ticket. But at this stage, essentially, if like I had this incident when a startup founder approached the investment fund I was working at in 2019, and he presented to me his financial model, which was put together very nicely. It looked like it was done by an investment bank, very detailed financial model with a discounted cash flow, but he was pre-revenue. And a lot of the times startups fail. A lot of the times they change their business model. For me to get comfort on those projections was very difficult. And he had a valuation of like over $30 million. And I'm thinking the whole time, most startups in Singapore that are that have some revenue are around $5 million. How is it that your pre-revenue business is $30 million? It just didn't make sense. And so you have to benchmark to your stage. What stage is your company in? Which vertical are you in to get the right valuation? Building these financial models just are not practical at these stages. It's good to have that financial forecast, to have that business plan. It shows you put a lot of thought into how the business needs to be executed and what is the expectation. And then it gives the investor a chance to basically monitor your actual results against these targets. But that I would say is the benefit of having a financial model, not to get your valuation. And then you have early stage where you have Series A, seed or Series A or even Series B, and then your valuation goes up. Expansion, A, B, C, sometimes Series D, E, depends, and then up to IPO. So these are the stages of development of a startup company. In terms of valuation methods, I'm going to touch on them. Although, as I mentioned earlier, for startup companies, very difficult to apply, especially when it's more early stage. It's very difficult to apply these valuation methods. The DCF approach, I would say, is the most subjective. It's an intrinsic value of a business. It looks at the forecast cash flows, could be 5 years, 10 years, up to the point when the startup becomes more mature. Again, who has a crystal ball to predict what can happen? Because as I said, companies fail. Startup companies pivot and change business model. Very difficult to apply the DCF. Market approach. For market approach, we look at revenue multiples because startups are loss-making, so you cannot use the PE multiples or the EBITDA multiples. So we use revenue multiples. Again, the challenge here is, how do you find good comparable companies? Because comparable companies are listed. Your startup company is very early stage. Listed companies are more mature, more diversified. So benchmarking to a revenue multiple is very crude. Then there's other metrics where you get value per user. At one stage, Uber was valuing itself as value per ride. There are different KPIs that investors would use as a benchmark to, or as a KPI to value a startup company. I have cost approach here. I'm not going to talk about that because cost approach does not capture the revenue generating potential of a startup company. So it severely undervalues good companies. But at the same time, if a startup is going to fail or go bankrupt, then ideally you want to try to understand what is the costs or what are the net assets that can be recovered. And this is when cost approach becomes most applicable. So given that these approaches are very subjective and a lot of uncertainty, which is why as valuers, we love precedent transactions. So what is a precedent transaction? When a startup company, and this was happening year on year for most startups, as we saw the earlier slide, WeWork had so many different funding rounds, like almost every year or every 2 years, they had a funding round. And so in each of these funding rounds, they are basically selling shares in their company. And this funding round and this selling the shares is a precedent transaction. And as valuers, we like to look at these precedent transactions and make that our starting point, because at the end of the day, a precedent transaction is less subjective than the other approaches that I talked about. It is market validated objectivity. It is objective because It reflects the actual value that's agreed upon by knowledgeable, willing parties, willing buyer, willing seller, the definition of fair value. So that's why when it comes to fair value, the first thing as valuers we look for is there a precedent transaction? Have the startup company sold shares in the past 1 year? We can even look 2 or 3 years because there are methods that we use that we just want to find the starting point. The problem, however, is that the transaction prices from startup funding rounds are typically based on the sale of preference shares. So preference shares have special rights. So you cannot simply imply the fair value of the entire company by grossing up to 100%. Because if the funding round is selling preference shares and you try to gross up to 100%, you're assuming that all the shares in the company are preference shares, which is not true. There are different classes of shares in the capital structure. And let me illustrate this point in a small example. So in CNN, there was the headline for one of their articles was, Grab is valued at $14 billion after getting investment from SoftBank. For those of you who don't know, Grab is a super app in Singapore. Basically, they started off doing ride hailing and then they moved into food delivery and fintech, so they do everything. And SoftBank invested in them in 2019. In 2019, SoftBank invested $1.4 billion in Grab for a 10% equity stake. Does this mean Grab is worth $14 billion? No, because the headline valuation numbers are not reliable measures of market value. Simply implying their fair value by grossing up to 100% is not accurate. This is because SoftBank invested in a special class of preferred shares that had rights and preferences above other classes of shares. So again, we cannot assume that SoftBank's 10% shares are the same as the remaining 90% shares. No, because the remaining 90% shares are lower classes of shares as well as ordinary shares. And that's why we then need to look at the cap table. So in the cap table here, you have ordinary shares, you have Class A, Class B, Class C, or Series A, Series B, Series C. And when you have a mixture of ordinary shares and preference shares, we call this a complex capital structure. And if we look at this cap table, you see there's also some convertible notes here, which is somewhat typical in early stage companies. I mean, typically these convertible notes will convert into series, into the next round of series shares. So actually I made a mistake here. This should be seed preference shares. This should be Class B, and this should be Class A and Class B. So in the past, IPO was the expectation because like I personally invested in a few startups back in Singapore. And the only way I thought I'm going to make money from my investment is this company that I invested in is going to go IPO and I'm going to become rich. That's what I thought. That was the expectation. And I didn't care. I actually invested in preferred shares, but I never gave two thoughts about it because at the end of the day, when an IPO happens, all the shares, all of these shares over here convert, even the debt, even the convertible notes, they all convert into ordinary shares. So all the shares are the same and everyone enjoys the upside. But in this new regime, IPO is becoming more difficult. As we said, investors want profitable companies now. They don't want to buy shares in loss-making companies. So IPO is becoming more difficult. Bankruptcy and M&A acquisition are the more likely scenarios, as we saw with companies failing and M&A picking up. So your startup being acquired is a more likely scenario, or your startup going bankrupt is an even more likely scenario. I haven't heard back from the founders that I invested in, and I think I can write down my investments to zero, unfortunately. So the cap table is more important now than before because it determines who gets paid first in a bankruptcy or an M&A, right? So let's say in this scenario over here, this company XYZ is acquired. Who would get paid first? The first that would get paid would be the bondholders. They would get their $3 million back. Next would be the Series B investors. And why I say Series B is because typically the later round investors rank high on the cap table. They have the hierarchy. It's factored into the subscription agreements of the preference shares. Not always. In some cases, they can rank pari passu, which means all the preference shares rank the same. But in most cases, I've seen that the later series rank higher. So in this case, Series B will get their money next, then Series A, then the seed investors, and finally, whatever is left over will be distributed to the ordinary shareholders. Now, sometimes whatever is left over can be further shared with the preferred shareholders. It depends on the different terms in the subscription agreements, and we'll talk about that. Yep. So now let's go into preferred shares. What are preferred shares? They are hybrid financial instruments, and they can have an equity component and a debt component. And for all the accountants that are on this call, sure, you've done the bifurcation. When a startup company has issued preferred shares, you have bifurcated between the equity and debt components, and then they are subsequently measured at financial year end, depending on the accounting treatment. The priority over ordinary shares in the payment of dividends and upon liquidation. So you saw earlier that the latest series would rank higher on the cap table. Dividends, startups don't declare dividends, but in some cases, preferred shares have a cumulative dividend, which is like an interest that the shares earn year on year. We'll talk about that. And typically, from all the subscription agreements for startups I've seen, there's a convertibility feature. So why do preferred shares exist? Well, startups do not have assets that can be collateralized, and startups do not have positive cash flow. So no one wants to lend to startups. Banks will never lend to a startup. Banks only lend against a collateral or against companies that have good cash flow, good positive cash flow. And startups are very risky. You want to lend money to them, most likely you're not going to get your money back. So therefore, they don't have access to debt capital markets when funding is required. Therefore, investors and often VCs step in to fill this funding gap. And as a result, the VCs require preferred equity because they want to reduce their downside risk, which means that in a liquidation scenario, they want to have seniority. And a liquidation scenario does not only mean a bankruptcy, it can also mean M&A or acquisition. And also, they have the conversion feature because the VCs, they want to protect their downside risk, but at the same time, they also want to enjoy the upside by converting into ordinary shares. So when the company does really well, they can also enjoy the upside. So interestingly, I read last week that Facebook turned 20 and declared its first dividend last week, which is interesting because Facebook has been listed for the last 10 years or so, and only last week they declared their first dividend. So startups don't pay dividends. And as an investor in a startup company, how do you actually get a return on your investment, if any? And I say if any because most investors don't get any returns on their investments in startups. And as I said earlier, the biggest one was IPO. Everyone expects their startup investment to IPO and they make money, but it doesn't happen very often. Then you have an M&A or a buyout. And in here, you're hoping that you'll be approached by Google or Amazon or Meta, and they'll buy you out and you will make a good return on your investment. The more likely scenario is that you will get bought out in more like a distressed scenario where there's no other option. It's either bankruptcy or selling your company to keep your company alive. And in that case, as you saw, if you invested in a lower class of share, or if you held ordinary shares as a founder or as unfortunately employees holding ESOPs, don't get much money in these scenarios. And lastly, bankruptcy. In a bankruptcy, I think there's actually not a lot of money to go around. So bankruptcy is essentially, you can just write off your investment. So M&A, buyout, bankruptcy, sale of all the assets, these are all liquidation events where you can somewhat try to redeem some value for your shares. Other than these scenarios, there's no other way to get money for your shares. In some cases, you can go to the secondary markets. There are these websites where employees can try and sell their ESOPs or sell their shares. But also there are then transfer restrictions on selling, employee share options or shares granted to employees. But there are secondary markets, like what we saw. Canva sold some shares in the secondary market, but that's because Canva is a really strong company, so it's very rare. So what are the purpose of valuing preference shares? So I'll talk about my experience. Most of my experience has been for financial reporting purpose. There's one case recently that I did for an M&A purpose, where our client was investing in a preferred share round, and they wanted to know what's the value of those preferred shares. And so we used the option pricing method for that. But most cases, we're using option pricing and all of these sophisticated methods is for financial reporting purposes because it's a requirement it's in the guidelines of the International Private Equity and Venture Capital Guidelines. And so when we say financial reporting, what are some situations? One is when a startup company issues preference shares, we need to fair value the preference shares, bifurcate it into its equity and debt components, and then remeasure it at financial year end, IFRS 9. Then you have VC fund portfolio valuation. So VCs are investing in preference shares, and so these preference shares would need to be fair valued at each financial reporting year end. And then you have ESOP valuation. So you have startup companies that are issuing ESOPs. And something interesting about ESOPs is that ESOPs are exercisable into ordinary shares. And so as we saw, The ordinary shares are at the bottom of the cap table. So you need to allocate the value first to the preference shares, and whatever's left over goes to the ordinary shares. And in most cases, it's very minuscule. And so we're going to go through some of the examples, and I show you how we take the value and we allocate it to the different classes of shares. So these are typically the most cases in which we use preference shares. Let's just talk about the key features in preferred shares. So we have the conversion feature, and this feature it can be voluntary. So at any point, if I want to convert, or it can be automatic. Upon an IPO, all the preferred shares will convert into ordinary shares. And you convert only if it makes economic sense. You don't want to convert into ordinary shares, because when you convert into ordinary shares, you lose your rights and preferences. So if you had that seniority, you will lose it. So you don't want to convert unless your ordinary shares are going to be worth way more. And we'll look at examples on that. The liquidation preference gives first priority rights. We saw that. It applies to winding up, liquidation, bankruptcy, M&A, or sale of asset. And as I said, once you convert into ordinary shares, your liquidation preference is eliminated. You lose it. The participating right gives you the ability to share in the upside. And this is a nice clause to have, because you can share in the residual with the ordinary shareholders, or the upside with the ordinary shareholders, without requiring conversion into ordinary shares. So you can still maintain your liquidation preference. So you have the downside protection, and at the same time, you can enjoy the upside. So this is great. The non-participating right is basically the not having this. So if you want the upside, you will have to give up your liquidation preference and your seniority. So not very nice, but at least you still have the option to convert to the upside and convert to ordinary shares and enjoy the upside. Then you have preferred dividends, which are cumulative, non-cumulative. Cumulative is just like interest, like you can look at it as like adding to the IRR of your investment. And I have seen this in rare in some cases. And then you have the holders redemption option, which is basically as an investor in a startup company, you have the ability to ask for your money back. Again, this is rare. I rarely see this in subscription agreements. And it's also hard to enforce, because like if my investments in those startups that I made in 2019, if I go to those founders and say, hey, I want my money back, they'll be like, sorry, we have no cash. There's nothing I can do. Call them into bankruptcy. What will I get anyway? So not very practical. Then you have other features, tag along, drag along, access to information, voting rights, and anti-dilution. I'm not going to touch on these because these are not reflected in the valuation or in the allocation. We don't take this into account. So now let's talk about the valuation methods. So the IPEV guidelines, or the International Private Equity and Venture Capital Guidelines, recommend three approaches, three methods. One is the current value method. The other one is the OPM, or the option pricing method. And then the PWORM, which is a probability weighted expected return method. The CVM, easy to implement, does not require many subjective assumptions. The weakness is not forward-looking, requires the equity value to be estimated via another method. This is an important thing to note. And something here to note is that you can use it when the liquidity event is imminent. And this is a key differentiator between CVM and OPM. And I'm going to go into detail and show some examples on this, so don't worry. The benefit of the OPM is that you can back solve for equity value based on recent funding rounds. And the good thing is that it's forward-looking, so it takes into consideration the potential future growth of your startup company, and we'll talk about that. It's more complex in CVM. It's sensitive to volatility. To apply the OPM back solve, companies with recent funding raised from third parties. So you need to have this. But there's a key difference between OPM and CVM is that this one is forward-looking, takes into account the growth potential, whereas CVM, you assume that the liquidity event is imminent, it's happening as of your valuation date. If you don't get this now, don't worry. We're going to go into examples and you'll get it just now. Probability weighted expected return method is a bit more subjective, a bit more complicated, where you try to apply a lot of probabilities to different scenarios. I rarely use this, so I won't talk about this much. Let's talk about the current value method. So my objective here is that I want you to leave this training with an understanding of the concept of OPM backsolve. And to understand OPM backsolve, first, you must understand the current value method, or CVM. Next, you must understand OPM. And these are not valuation methods. These are allocation methods, equity allocation methods. For these, we need to know what the equity value is. And we use these methods to allocate the equity value to the different classes of shares on the cap table. And we'll go through examples. So only once you understand CVM and OPM, then only will you be able to understand OPM backsolve. That's my goal. The difference between CVM and OPM backsolve is for CVM and OPM, equity value is first determined using a traditional valuation approach like your DCF or your market approach, or even somebody wants to buy you for a specific amount. For OPM backsolve, we use a recent funding round to backsolve for the equity value. And we'll talk about this as well. So the current value method is basically allocating the business value across the cap table. It's also known as the waterfall method. Anyway, the business value needs to be determined first, and the assumption is that a liquidity event is imminent. So that's the assumption when applying the current value method. That's a key, that's something that you need to keep in mind, is that the assumption is that whatever value you have, that is the value of the company, of the startup, and that value is not going to change. And we'll talk about why this is not practical later on. But for now, assume that the company is going to be bought out or the liquidation event is imminent. So you need to determine your business value or enterprise value. I'm going to use these interchangeably, like business value, enterprise value, or equity value, because in most cases, equity value and enterprise value will be similar for startups because they don't have much debt. So assume here we did a DCF valuation and determined the business value to be $10 million. So this entire triangle represents the full business value or equity value. So in this example, we have a liquidation preference only. There is no participating right. There is no conversion feature here. So this is a simple example. And so if you look at this example over here, let me try to put this on a different screen to make it easier so I can write. But here we have the Series A investor. They invested 2 million and they have a 1x liquidation preference. Series B invested $3 million with a 2x liquidation preference. And as you see here, I've seen this, it's rare, but if the company is sold for 10 million, the Series B will get 6 million in this, and the Series A will get 2 million, and the residual will be shared between by the ordinary shareholders. So in this case, you have the starting point would be 0, and then up until 8 million. So this would be at 8 million is where the liquidation preference for the preference shareholders will enjoy, and anything above 8 million will go to the ordinary shareholders. This is common shares or ordinary shares, and that will be 2 million. This is a simple value allocation, and we like to draw these triangles. This is the total value. Okay, let's go into another example. So in this example over here, we have a liquidation preference, we have a participating right now, and we have a conversion feature. So in this scenario over here, the preference shareholders will enjoy their liquidation preference, and then because they have a participating right, remember they can, and without converting, they can still share in the upside. So as you see, they're sharing in this upside with the common shareholders. So this entire piece before was only for common shares, but if you have the participating feature, you can actually share this with the common shareholders. Right? In an example here, over here, so you have a 1x liquidation preference, a 2x liquidation preference. This one is participating. So how does this work? The company is sold for, so assume a buy for $15 million. So the company is sold for $15 million. Series B will get 6 million because they have a, sorry, this should actually, yeah, this is $3 million at a 2x. They should get 6 million. This guys will get 2 million. The leftover is 7 million, right? This 7 million, because Series B is participating, they would now share in the upside on an as-if converted basis. So you look at the total number of shares, which would be this 4.5 plus the 10. We ignore the Series A because they are non-participating. So you have the 10 over 14.5 and the 4.5 over the 14.5, and you apply basically prorate, you share the 7 million upside. Here's the same example, but visualized. Okay, wait, sorry. This is actually the next example where now you have no participating right. So you don't have this participating right. And in this case over here, if you don't convert, you will only enjoy your liquidation preference. So you don't convert, you enjoy your liquidation preference. Then the common shareholders or the ordinary shareholders will enjoy the upside. At some point, at some point, it would make sense for you to convert, because if you convert, your upside is going to be worth more than this, right? So your upside will be worth more than your liquidation preference. So at this point over here is when you want to convert into ordinary shares, and you want to then enjoy the value with the common shareholders here. So the saying is that you will only convert when what you gain is more than what you give up. What you give up is your liquidation preference. And just something to note, these points over here are called break points. At different points in the capital structure or different points, we call them break points. And just keep that in mind because we will talk about that later. Moving on, this is the same example. So at this point over here, we said it makes sense to convert, economic sense to convert. Remember, what you gain must be more than what you give up. So if we want to try to solve for this conversion price, we use this formula over here. Basically, this is what we're solving for. The value, the business value at where it makes sense to convert, okay? Where you take the number of preference shares divided by the total number of shares times the business value, that gives you your share of the business as though you converted, and it needs to be more than the liquidation preference. And let me show you a quick example. You see that the buyout is at 11 million. So the business value is 11 million because somebody's going to buy you out for $11 million. And your shares here, you have a 1x liquidation preference. They're non-participating. So this is participating, right? If you convert, you will have 16.7% of the total business. And 16.7% times 11 is 1.8 million. But your liquidation preference is worth $2 million. So do not convert. It's not economical at this point. If the business value is at $12 million, then you see your 16.7% once you convert is actually equal to the liquidation preference. So if the business value is more than $12 million, at this point is when you want to convert. So if we come back to this triangle here, so up until we said up until the, what was the liquidation preference is 2. So up until 2 million is the first break point. Then up until 12 million is the second break point. And then if you convert, then you share the upside, which can be infinity, right? You don't know how high this company price can go. And then you share with the common shareholders. Oh yeah, this is the same thing. So 2 million, 12 million, infinity. So up to this point, we have been assuming that the liquidation event is imminent, right? Taking place as of the valuation date or whatever your financial reporting year end is. But is this practical? No, because in most cases, while we need to do the fair value as of a particular valuation date or financial year end, the liquidation event or IPO is far into the future, right? The liquidation event is not imminent. It's going to happen in 5 years, 10 years. You need to make that assumption, but it's not going to happen now. So the value of a startup will be fluctuating between the valuation date and its eventual exit. And when I say eventual exit, it could be M&A, it could be IPO, it could be bankruptcy. So what do we do in this case? So when you have a situation where you have time, okay, and your startup, the value of a startup will be fluctuating, right? So it will be volatile, right? How do you, what do you use to model these different range of outcomes? That brings us to option pricing method. We use option pricing to model the different range of outcomes that a startup company can experience over a given time period. And so we have our exit maybe 7 years later. And as I said, your startups are volatile, right? The investment is volatile. The range of outcome can be 0, can be millions. And I'm not going to go into the Black-Scholes model, but we apply the Black-Scholes model to basically forecast the different range of outcomes. And you have your spot price, your exercise price, risk-free rate, dividend yield is usually 0. You have your volatility. Usually we apply a very high volatility for startups, and you have your time to maturity, which is the time to exit. Something to note is that this exercise price is basically, remember I talked about the breakpoints? At each breakpoint, we will have the exercise price or the strike price at the breakpoints. So just a quick one. So investing in startups is like buying options, because VCs invest hoping the startup will grow and significantly increase in value. Options trading and VC investing are both risky, since startups can fail and options can expire. So your startup fails, your investment goes to 0. Your option expires, your investment goes to 0. You can decide to invest more based on the startup's performance. So you have time, and at each funding round, you can put more money in, and startups can be highly volatile. And this volatility and how we capture this volatility is by using option pricing. So remember, under OPM allocation, we said that the business value must be computed first. So similar to CVM, for OPM allocation, you compute the business value. So we said that first I'm going to teach you CVM, then I'm going to teach you OPM, and last I'm going to teach you OPM back solve, right? So we covered this. Now we're going to cover OPM. So first, for OPM, first you need to determine the business value, equity value, enterprise value, whatever it is, and that can be done using DCF, market or cost, or you can even have an offer for your company. Somebody makes an offer to buy your company. And step 2 is you use the OPM to allocate the value to the different classes of shares based on special rights and preferences. Let's see how. And then the only difference between OPM and CVM is that now OPM is taking into account the Black-Scholes because we want to try to figure out the range of outcomes of the startup over the time period. So the key steps under the OPM is determine the business value, determine the Black-Scholes assumptions, understand the capital structure. You need to understand the cap table to determine the breakpoints. Remember we talked about and set the strike prices. Remember we talked about at this point it was 2 million, at this point it was 12 million, at different points. So these breakpoints are the different strike prices for your options. So in this case, we'll have multiple options that you would need to value. And then you run the OPM to allocate value. So in this example over here, it's exactly the same as what we saw earlier, but in this case, we would calculate the value of two options. So we would take the value of this total option here, and this will essentially be what equal to the business value. And this option would have the following assumptions. You would have your total enterprise value. So if we just look here, so I hope I'm not going too fast, but I see we're running out of time. So the total will be the enterprise value, the total value of this square, the liquidation preference. So for this whole piece over here, this should be TEV. The strike price is 0 because here you start from 0. And then you have your risk-free rate, your dividend yield, your volatility, etc. Then for this option over here, for what the common shares will enjoy, we look here. Again, you have your total enterprise value, but here you will have your liquidation preference as the exercise price, and then you have your other Black-Scholes assumptions. And so the value of the preferred shares will be this value of this overall option, subtract the value of this common shares option, you'll be left with the value of your preferred share option. And here, it's the same thing. You would start off by valuing this entire option over here. The strike price would be 0. And then you would value the second option over here. The strike price would be the liquidation preference. It could be 2 million, whatever it is. But in this case over here, you take the big triangle, you minus this triangle, you get the value of this piece over here, right? So the preference share is equal to the overall minus the second triangle, right? But the preference share is also getting the upside. So I plus the preference shares upside here. So I'll take a percentage of this option value and give it to my preferred share. Again, this is much easier to see in Excel, and we'll try to show you 1 or 2 Excel. So in Excel, here we have the same example as the previous slide. The equity value is $5 million. We have our Black-Scholes assumptions. The time is 5 years. Risk-free rate is 4%. Volatility 63% based on comparable companies. And then the value of that big option, so the value of this entire triangle is 5 million. And then the value of the second triangle here, so let's just call this 2. The value of 2 is 3.7 million. So the value of this liquidation preference, I can just say is equals to this 5 million, the big triangle, subtract this number 2 triangle, the 3.79 million, it gives me the 1.2, okay? So this 1.2 is fully attributable to the Series A. It's a liquidation preference, right? So the Series A. But then this triangle here will now be shared because there's a participating right. It will need to be shared between the common shares or the ordinary shares and the Series A. And the way we share it is on an as-if converted basis. So we will take 25.5% times this 3.7, and then that will be the preference shares piece of this triangle plus the liquidation preference, and I will get the fair value of my Series A shares. And as you see, the fair value of the Series A shares is worth more than the fair value of the ordinary shares because that liquidation preference is, of the entire value, the liquidation preference is contributing to 1.2 million of the 2.1 million value here. I'm really sorry, we're running out of time. If you guys have 5 or 10 minutes, then we'll just finish up and try to do some Q&A. We're almost done. So here's when you have no participating right. Again, the difference is that you're just going to have more strike prices. So you'll have 0, you'll have the 2 million, you'll have the 12 million, and then you'll have the infinity. And these different strike prices will mean different tranches. And let me show you that in Excel. So here we'll have tranche A, where we have the 0 as the starting point. Tranche B will have the 2 million as a starting point, and C is 8 million, which was the next break point, the point at which it becomes economical to convert. And then we will get the value of the different squares or the different options. And then we will, based on the percentages, we will then allocate it to the different classes of shares. So now let's just quickly talk about OPM backsolve. So you saw that using option pricing allocation, we need to have this number here. We need to already have this number here. But for OPM backsolve, we don't have the equity value. We need to backsolve for it. And in order to do that, there must be a recent funding round. Typically, ideally, this funding round should be at least 1 year, within 1 year. But even if it's 2 or 3 years, it's still better than nothing because it gives us a starting point, and we can use calibration, which is a different topic. But we like to have a recent funding round, even if it's more than 1 year. And we use this information from the recent funding round to backsolve the equity value. And I'm going to show you how. The process or the setup of the Excel is exactly the same as OPM. The only difference is that we don't have the equity value. So let me show you this quickly. So this is the exact same setup as the previous examples. The difference here is that this is a plug. So I just randomly put 5 million here for now. I don't know what this number is. And I set up the rest of my model, and I get this 5 million, as you see, is allocated 2.1 to Series A, 2.6, and there's some ESOP. ESOP is ordinary shares, essentially. But then I read the subscription agreement, and the VC fund invests $3 million into company XYZ in Series A for 25.5% equity stake. So if the VC fund invested $3 million, right? Let me highlight the Series A, their 25.5% stake. So this is the VC fund's investment. The fair value of this investment is not 2.1. The fair value of this investment should be 3 million. So that's what we mean by backsolve. So we're going to use the goal seek function in Excel, and we're going to set this 2.1 to 3 million by changing this over here. So if I do that, the fair value of my Series A matches what the VC fund is paying for. If the VC fund is a third party transacting at arm's length, their 25.5% stake is worth 3 million, which is what we have here. So this is correct. This is fair value. And in order for this to be worth 3 million, this enterprise value or equity value should be 7.8 million. And so this is what we back-solved for. And then you nicely see that this 7.8 million is allocated to the Series A, the ordinary shares, and you see that it enjoys a much higher value than the other classes of shares. Now, this can get super complicated when you have Series A, B, C, D, and even convertible notes in the cap table. But it's the same logic applies. And once you know how to set up the simple model over here, you can actually do any more complicated OPM. So that brings us to the end of the session. And I'm sorry I went a few minutes over. I have a few questions here. If the convertible note holders have yet to convert into ordinary or preference shares, are they considered part of the cap table? Yes, they are considered part of the cap table. First of all, they are considered part of the cap table because convertible notes, while they are debt, according to the agreement, because they are debt, but they are equity-like, because in most cases, it's very rare for investors to get their money back. So in most cases, they are going to be equity-like, so they would be part of the cap table. Unfortunately, I won't be sharing this deck, but I will be sharing a recording of the session to all those who attended. Thank you so much for taking the time to hear me talk about startups and valuation. I enjoy the stuff, and look forward to having you on a future webinar, and just keep a lookout for the email. And by the way, just one more thing I want to share. For those of you who want to know more or who want to learn how to actually do this in practice, I'm actually putting together a workshop. It'll be a paid workshop. And in that workshop, I will go through building together the Excel model together. We'll do one practical walkthrough together. I will give you a few real life examples to do yourself and check it for you. It'll be a few hours workshop. It will give us more time to go into the details. If you're interested in this, please drop me a message on LinkedIn or drop me an email, and I can share more details on that workshop. Thank you all for joining, and I wish you a good day further. Bye-bye.